Hey everybody. So I've always thought that there needs to be a bite-sized approach to learning financial modeling. I mean, there are many people who want to learn the skill, but usually are quite overwhelmed by the prospect of it. I remember in my college days there used to be a course called security analysis where they taught financial modeling, and everybody thought it was some exotic skill that could only be learned by from a wizard. But that is, as with any difficult subject, that is definitely not the case, especially if you take a step by step approach towards learning it, right? So I thought of making this video just to show you what a financial model was like. It doesn't have to have, financial model in the least does not need to have 20 sheets, 100 rows per sheet, complex formulae, you know, very complex designs, this and that. But a few major ingredients that construct a financial model, right? Number one, there should be some inputs. If we change those inputs, the output of the model should change. Number two, everything would link together, it should link together in a reasonable way, right? For instance, if you want to increase the price, I mean, a financial model is the basically it's future financial statements, right? So if you are changing the price, it should change the revenue and then it should increase your net profit. But by exactly how much, you get to know that from the financial model. This and a lot of combination of inputs and outputs. So let's dive in, and I think I should be able to make a model from scratch for you in 10 minutes if you bear with me. Thank you. All right, so here we have a blank canvas which we can use to create our financial model. We'll have every model needs to have years at the top. 2026 will be our base year and then we'll build on it. So we are projecting for 4 years, sorry, 5 years, with the first year being the base year. So any model starts with the income statement. And the income statement starts with the revenue. And how do we get the revenue? We multiply price by volume, right? For especially for manufacturing companies. So let's assume this is a manufacturing company and it has a price of 100 bucks. All right. It has a price of 100 bucks per unit. And we'll just link this. Everything needs to be linked in a financial model. You can never have punch in numbers, right? So, so here and we have an input of 100. We have just linked the price to all the years, right? For all the years, the price is the same. Let's make it yellow. Okay, and let's say there is a volume. Volume starts with 100 as well, and we'll link this one as well. 100 units. Okay. Now what we could do here, we could make the volume dynamic, as in we could make it have a growth rate as well. But we'll try to avoid the bells and whistles as much as we can and make it very simple, all right? So that we have the structure of a model, we can see a model, and that is it. That is our goal here, right? So revenue is gonna be the multiplication of both of these, right? $10,000. Let's say the currency is US dollars. So this is our revenue, and then we look at the cost, right? Let's assume it costs us 50 bucks to make an item, right? So our cost is gonna be 50. We'll put a dollar sign here. Okay, and multiply it by the volume, which is here, then 5,000 bucks. All right. Let's put in some detail, right? Let's say there are some overheads, and which are mainly rents and salaries, right? So let's say there are salaries of or overheads of $1,000 every year, and these are the overheads. Like we could break it down into salaries and rents, but we are not doing that right now. Okay. All right. So these are all the costs, right? So these are costs, the overheads and the variable costs. These are the total cost. Let's make this variable cost for good order. Okay, so the total costs are 6,000 every year, and then we get to have the profit before tax. So this should give us the profit before tax, right? So another thing that is a bit simplistic here is we could have debt also, right? And because we are not showing any interest costs over here. We could have debt also. Debt is something pretty basic, but we are skipping that here. And yeah, so that is about the debt and the interest cost. There is no debt in this company, all right? Let's say there is tax as well, 30% tax rate. So we multiply it by we add the dollar sign to it and multiply it by the profit before tax, and that gives us the tax, and then we have the profit after tax, which is PAT for short. Let's write it full. Okay. So we subtract tax from profit before tax, we have the profit after tax. So this is the income statement, right? We'll just write this here. This gives us the income statement, and let's move on to the balance sheet, right? Because the balance sheet is the second important financial statement, and it always starts with cash. But we'll do cash in the end, all right? We'll do receivables. Maybe the customers take 30 days to pay on average, right? So the formula for receivables will be 30 divided by number of days in the period, which is 365 here, and multiply it by the revenue, right? And we'll add the dollar sign here because we are dragging it, right? So this is the revenue, sorry, the accounts receivable. We'll add the comma here. We're using the accounting format, and these are the receivables, right? And let's just say that this is a manufacturing company, right? So we need to have a factory or some plant and equipment, right? I think that is important. We cannot just go do away with that, all right? We could do that, but that would make the model too simple. So let's say there are fixed assets, and they cost us $1,000. Sorry, $10,000 to set up in the first year, and we need to depreciate them also. So what that means is we decrease the value of the assets every year in simple terms, right? So this is obviously not an accounting course. This is a financial modeling course. So we'll skip into the mechanics of that, and we'll just say that we depreciate it by $1,000 every year. So these are the fixed assets. We call them the book value of the fixed assets. So these are all our assets. The total assets are done, and cash will be done in the end. So these are our total assets. Sorry, we make it the accounting format. Okay, what's wrong? So yeah, we drag the formula. These are the total assets. And now we move towards the liabilities, right? So let's say, obviously we are assuming no debt. So there will be no debt on the balance sheet. But there has to be some accounts payable because everybody takes time to pay their bills, right? That is something usually standard in the industry. So maybe it takes us 30 days to pay our vendors. So in that case, 30 divided by 360 multiplied by the costs, total cost, right? So again we'll add the dollar. No, we'll add the dollar sign to the receivable payable days, and that is it. So $500 worth of payables every year, all right? And this is it. These are all our liabilities. So we'll just write liabilities here. There is no debt, otherwise debt would show up here, as I said. Now we come to the equities, right? The equity, the paid up capital. Now the equity in very, very simplistic terms, once again, has paid up capital and retained earnings. So we'll start with paid up capital, right? The paid up capital is usually the amount of money that took to start the business, right? Over here we are, which means is we are using that money to buy our factory or maybe build it, and it is ready by the year by 2026, by the end of 2026. So we'll just make it equal to the assets. We need to do that, right? So these are essentially our assets, and we're gonna finance them by our equity. And then the second component of paid up capital is retained earnings. That comes in when we have profit, and basically it is the cumulative profit that is earned by the company. This goes here. The paid up capital stays constant unless the company raises more capital, which does not always happen. All right. So here we have the paid up capital and the retained earnings. So this gives us total equity of the company, right? The total equity, and we also need a final line item which is called the total liabilities, okay, plus equity, and that is gonna be total equity plus total liabilities. So we can see that our balance sheet is not balanced, and we also need to fix one more thing here. 2026 was the year zero, right? So it's not gonna have any operations. This is the year we set up our factory and raise capital and this and that, and maybe have a trial run of the factory or whatever. But it will not have any operations and no commercial operations per se. So this year will have to be empty. There will be no, I mean, we can have price here, but no need to have that here, right? We can delete this. The volume will also start from 2027, so we delete this also. No revenue, no variable cost, no overheads also. All right. So okay, so we made a mistake here. We used punch-in numbers in the model, which is not good. So we link it like this. All right. So I'll correct things as we go. All right, because this is how models are generally made, right? You refine the model as you are going along. So we see that in the first year we have made it zero. But the balance sheet will need to have some numbers in the first year, right? And those will be, the fixed assets, because we need to put some assets in place, and the equity that we put in from our pockets to buy those assets, right? So that is it. And then obviously a check sum. We also need to always need to check whether our balance sheet balances, because anybody who knows even a bit of accounting will need to understand that a balance sheet always needs to balance, right? That is, I think, accounting 101, the first part of accounting 101 even, all right? That the balance sheet balances. I'm sure anybody who's watching this video knows that already. So let's move on to okay, we'll notice one thing, obviously, that the balance sheet does not balance. And the way we'll do that is by filling this cash, and this cash will have to come in from the cash flow statement. So let's move on to the cash flow statement. So the cash flow statement, I guess, is the most simple, could be the most simple. I mean, it has the fewest lines, but it's usually the most confusing as far as financial models go. And this is a pain point everybody who's starting out has to go through this pain, and even experienced guys, they're never, it will, I mean, for me at least, it's rarely the case that I get it right in the first try. Because your job is to balance the cash, the balance sheet, right? Let's see what happens when we do it here. So it always starts with the net income. So we're using the indirect method, the profit after tax. Then we add any non-cash items, which is depreciation over here. Okay, so we did one thing here, we skipped one thing. We said that we would decrease the value of our assets, the fixed assets every year by 1000, but that 1000 needs to show in the income statement for keeping everything sane, right? So ideally it should come in from here like this, and then we should decrease the fixed assets by this amount. Again, you can see that we were subtracting 1000 from it. Again, this is not right. We cannot have numbers in the financial model, all right? No numbers in the years of the financial model, the operating years or whatever. Anywhere in the model sheet at least. Any numbers go into the assumption sheet. So that is, again, financial modeling 101 for you. So yeah, this is, so we need to link it completely now. So this part is done. So yeah, so coming back to the cash flows, we put depreciation back here. And yeah, and then working capital changes. Now I'll be a bit, I'll have to make this, like I'll have to take this liberty of creating a working capital statement, even though I said I would keep things simple, but it's important that we have it, right? Because I think that is important, because any business, it has receivables and payables, so we can't really skip that, right? Even we have inventory, but let's say that we forgot inventory here, but maybe let's say that this is a very efficient business and it just buys inventory when it needs it, right, and uses it right away, so there is no inventory here, whereas usually that is not the case. But so coming back to the working capital statement, so the working capital statement basically shows us the changes in all the working capital accounts, which are 3 in the company, right? Inventory, accounts payables, and receivables, right? So we don't have inventory here, but we'll put in accounts receivables. We'll just call it A/R now, and account/payables. And the receivables, the change in receivables obviously will be the previous year. We are subtracting the previous year's balance from the current year's balance. So this is important. Otherwise, our balance sheet will be thrown off. So, and the payables are always the current year's balance subtracted from the previous year's balance. All right. So let's fix this. All right. Again, drag this formula. And the working capital change total is a sum of these. All right, and then we put that working capital change in the cash flow statement. Let's put some more gaps here. So is this it? Is this our cash flow statement? We take the net change in cash. We just sum all of this up. And I think we're gonna balance our balance sheet in the first go, which is rare, but nevertheless does happen from time to time. So yeah, and the cash balance is obviously cumulative. So this is it. This is our balance sheet. It balances, and we have the cash flow statement as well. So this essentially is the financial model, right? There is no formatting here, absolutely no formatting, except for maybe making the numbers in accounting format. There is no formatting. We can maybe keep that for a later video. But this is your financial model, right? So I mean, we can have graphs here as well, but we can put them in a different sheet. But if we don't have them, that doesn't mean that we are not fulfilling the basic criteria of a financial models. Now in the beginning you saw that I kept some variables independent. All right, so price was an independent variable, and what that means is, if and it is linked to everything, right, as with many other things over here like volume and variable cost. So a typical question in financial statements is, how does our net income change over the years if we change the price? All right, so how do we do that? We just, let's say there is a 20% increase, so we make this 120, and our profit after tax increases. You see, everything changes. I'll just roll back the change and just to show that how things are changing. So you see everything changes, the balance sheet changes, everything changes. Now if we had some more layers in this model, we could have some investor related metrics also and show how much return they were making. But essentially this is our model. So if you have any questions, comments, please let me know. Thank you.